my channel. Today we're going to break down the economy activity for this week. I'll give you a quick and clear view of the important stuff that could shape how the market moves and what is going on with the money. Listen up, because what we're diving into isn't just numbers, it is news that can really change how the market works and help us see better ways to make smart trades. Remember, the more you know about the economy, the better you can do in your own trading. So, no more waiting around. Let's jump into the world economy insights, where the big global money stuff meets opportunities in the market. JOLTS, initial jobless claims, non-farm payroll (NFP), and unemployment rates is expected to be unchanged. When JOLTS, jobless claims, non-farm payroll, and unemployment rate remains unchanged, it is generally indicating stability in the markets and the economy. This could suggest that there is no significant shift in the employment trend or labor conditions, which might result in minimal impact on financial markets, as investors may perceive the status quo as reflective of a steady economic environment. GDP growth rate expected to increase. Strong GDP growth might lead to concerns about increased inflation, prompting central banks to increase rates further to curb this. This could lead to a higher borrowing cost for businesses and consumers, potentially dampening spending and economic activity. As a result, stock market might experience lower growth, while bond yields could rise as investors seek higher returns from fixed income interest due to higher interest rates. Corporate profits expected to decrease. Decline in corporate profits can indeed indicate reduced economic activity. It suggests that companies are earning less, which can lead to a cautious business investment, reduce hiring, and potential layoffs. This combination of factors can contribute to slower job growth and increase in unemployment, impacting both the economy and market sentiment. PC and core PC expected to increase. There are two scenarios that can affect the overall structure of markets. One, higher than expected inflation. If PCE or core PCE is higher than a forecast, it suggests that consumer prices are rising at a faster rate than anticipated. This can lead to concerns about inflation, as it indicates that consumers are paying more for goods and services. In response, central banks might consider tightening monetary policy, rising interest rates basically, to control inflation, which could potentially impact borrowing costs. Investment decisions and financial market might react with increased volatility as investors adjust their expectations for future economic conditions. Now, secondly, lower than expected inflation. If PCE or core PCE is lower than forecast, it suggests that consumers are rising more slowly than expected. Consumer prices are rising more slowly than expected. This could indicate weaker consumer demand or economic activity. Central banks might consider loosening monetary policy, lower interest rates to stimulate economic growth. Financial markets might respond positively to lower inflation, as this includes lower interest rates, potentially boosting borrowing and spending. Now we'll be jumping into the charts to have further look on the price action and what to expect for the rest of this week and today for New York session. Now let's jump on the charts. We have to go back to last week Friday to see what Powell said at the Jackson Hole Symposium. At the Jackson Hole Symposium, Powell reaffirmed that the Fed is committed to lowering inflation down to 2%. They have tightened the policies, though inflation remains elevated. They are open to raising rates more if needed and maintain a restrictive policy until confident about the sustainable inflation reduction. Inflation has eased from its peak, but core inflation, excluding the food and energy sector, remains still high. Different sectors show varying progress. Core goods inflation is falling due to supply and demand adjustments. Housing sector is affected by higher mortgage rates. Non-housing services have had a mixed progress. Economic growth has slowed due to tightening policies, but signs of strong GDP and consumer spending are noted. Labor markets rebalancing has eased wage pressures, but uncertainty about policy effectiveness and inflation dynamics and supply and demand disruptions complicate the decisions of the Fed. They're carefully evaluating the decisions and the data to decide on future policy actions. This indicates that the Fed is still hawkish, and we now can see the dollar gain more strength, and this means bears for gold. Now let's jump on the daily time frame and analyze the charts. All right, now let's see the markings, right? During COVID, we saw price plummet on all pairs as COVID lockdowns was unexpected, and this created a huge FUD due to the whole economy being on a lockdown. Then the Fed came and gave assurance to support the economy by their bond purchasing program, which gave a boost to the economy. Price then started to fall as the Fed began talks about tapering and selling their bonds at this high. We saw price go to the 2050s, and the increasing rates, which saw a massive rally up for the dollar and rally down for gold and other pairs, as this meant that the time for easy money in the markets are over, and it costs a lot more to borrow, so institutions pull their money out. Gold price went down to 1650s, as we can see here. We then had Russia-Ukraine war around this time, which increased the level of FUD, and we saw gold rally to the upside due to the safe haven nature. When news about Russia and Ukraine became repetitive and the institutions stopped caring much, the FUD became down, and this caused them to pull their money out of gold and put it into risk-based assets. We still had Fed increasing rates during this period at a rapid pace. Gold prices fell down to 1600s before starting to push, and then we had the SVB collapse. As you can see here, we saw the SVB collapse happen, which increased the FUD in the market, as people did not know if they're going to have their money into the bank, in the bank, and if the bank is going to survive. The Fed and the larger banks came to the rescue, and this ensured the people that there is nothing to fear about. And now we're following the structure as previous. Where gold is coming down and the dollar is going up due to Fed being hawkish and news being in favor of the dollar. The investors are no more afraid, as VIX came down to the 16s, which is a historical low. This saw an outflow from the safe havens and inflow into the risk-based assets. Price has been bearish for the past few weeks, and we can see it has had a smooth sail to the downside. We expected a pullback happen as pullbacks are normal due to investors wanting to liquidate their positions to get at better price points for higher profits. Last week we also had PMI, which we saw a decent drop from the previous data and the forecast. This gave gold a rally, a gold momentum to push up. For more information, please watch last week's London session stream, as we predicted the numbers and the data and what it means for the market. Now for this week, we have a lot of news coming up, which can bring a lot of volume. Please rewind back to the economic calendar section for further analysis on what we're expecting and what can happen to the markets. Now let's jump on the hourly time frame and see what we have for this week and what we can expect to happen. This is mostly based on the data that we have previously mentioned in our news section. Please rewind back and see what we can expect, right? Now, based on the data this week, if the data that we're expecting comes out worse for the dollar, we can expect price go to the 1940s before we start to have a rally down. And for better price points, if we get down to 1930s, 1928s, 1930s, if price comes to these levels and starts to reject like we have seen in the past, we can expect price to start pushing down to these areas. Once we hit 1930s, we start to rally down. Now again, this is mostly based on data, and it will be best to wait for a break and retest level, and once we have the data confirmations, we can take the sells from 1930s and we can easily hold it down to 1880s. Now the best and the safest option is wait for sells below 1912, wait for the data to come on positive for the dollar, as it is expected the GDP to increase and the other data to also increase, so this gives rally up for the dollar and downward trend for gold. Now the safest possible sells we have is below 1902. Why do we have 1902? As we can see, every single time we closed below 1902, we came down to 1880s and we went down much further. Now let's go on the higher time frames and see where we can expect price to go. As you can see, every time we went below 1880s, we then started to push further down. We went down to these lows. We went down to these lows. And next point we can go is down to 1700s. And then we can easily have our price, we can carry on sells below this level and go to 1600. Now this is mostly based on data, and we need to see what the data is. Now you have to decide and see what you're gonna expect from the markets. Please stay vigilant and go on lower time frames as usual to see what you can do for overall markets and see where you can enter. Make sure you do not over leverage, make sure you do not over risk. These analysis is mostly based on higher time frames, as we can see. Now we're going to be jumping on lower time frames and see what we're going to expect. As you can see, now we're on the 5 minute time frame. We can now go and have a deeper look on what to expect for today and for the week to come. The higher time frame will give us a better price point and better understanding of what to expect. Now we keep rejecting 1950s level. Now once we break this level, we can easily see a price to go to 1920s. Once we break this level, we can have a retest of this level and 1920s, and we can start to push further, where we go to 1930s again. Once we hit this level, we can start to decide on what we're going to do based on data, and see if we can take ourselves from 1930s or 1939s. If price breaks above 1930s, we can see price going to 1939s, 1940s. Now let's see what we can do in terms of entry points. So once price goes to 1920s, if price rejects like here, we can get the safe sells. Once we come down, we retest 1920s and we can have the sells below. If not, price comes up and goes to 25s. We can expect price to go to 25s and go to between 25 and 30. But if we have better prices and we see something like a retest like this, we can expect price to come down. Now the other entries which will be much safer, which is below 1912, we come down, either a break or just a break and a retest, and we can get the sells at 1912, and we can have our stop loss around 1914 for a 20 pip SO and easily grab it down. We had this similar entry during Jackson Hole Symposium after Powell's speech. Easy sells, we had the same sells, same entry at 1920s. Now what to expect for below 1902. Now below 1902 we have a lot of rejections. We came up, we came down, we went up again, we came down. As you can see, it's not that clean, but what we can say certainly is once price breaks 1902 and keeps and sustains below 1902, we can expect price to come down to 1885s, 1883s before we start to see any sort of rejection. As you can see, price came down again. Once we broke 1912, we came and retested 1912. We went down, we retested this area multiple times. We still stayed below. Once we even went back up to 1902, we then we went up a bit. We couldn't sustain the price much further. We came down and then straight away pushed. This is a really good price. As we can see, price repeats itself multiple times. We can get these entries, we can get these nice entries and have better price points and much low risk. So wait for something like this to happen, and you can grab the sells down below to 1902, and that's about it. Stay vigilant and watch what the markets are doing, and do not over risk, do not over leverage, as it never ends well. If you guys like this type of analysis, please let me know in the comment section, and you can directly message me on Discord or Twitter, and I can try to do these type of analysis every week for the whole week and for the weeks to come. Thank you. Hope to see you guys later.